Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning, Tuesday this week because of the holiday, but with the stocks to watch and the stock market news you need to see. And with the market reaching new highs, all eyes seem to be on AI stocks and big tech. It's too bad because the real money has been in penny stocks, but few people are paying attention. The 7 penny stocks I highlighted in November are already up an average 143%, with SoundHound AI still posting 160% returns even after Friday's crash. Valuations have gotten stretched though, so you can't just buy any penny stock. I'm digging deep into the research to find 5 more penny stocks under $5 to watch this week, along with updates to Intel Corporation and Nvidia. But first, if you aren't using options investing yet, what are you waiting for? I asked the Bowtie Nation how they've been using our options investing course and was blown away by the response. George made over $26,000 buying the $30 calls on SMCI, a 315% return in just 2 weeks. Justin made a 380% return on a call option strategy in 1 week. And longtime Bowtie brother Chad generated over $10,000 in income this month across 5 stocks, from Amazon to Alibaba and Nvidia. And to help you get started, I'm relaunching our Ultimate Options course. Over 3 hours of video, I start with the basics, then walk you through 29 option strategies, when to use them, and how to set them up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy, and an options calculator to show you exactly how much you can make. And right now, I'm relaunching the course at a 38% discount. Save $150 off. You'll get all the basics to get you started, that strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much you'll make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. That $150 launch discount is only available with the coupon code in the link I'll leave in the description below, so look for that link or scan the QR code here. Back to our main topic though, and with the bull market into its 3rd year and penny stocks flying even higher, it's becoming increasingly harder to find good deals and stocks under $5 each. Our 7 penny stocks from the November video are up an average 143%, with Gorilla Technology, ticker GRRR, a stock I said to buy at $2.70 a share, now it's $27 each. That is 10 times your money in less than 6 months. Now I've found 5 more penny stocks to watch. Some of these I'm buying right now, while others I want to research a little further, but all under $5 a share and all with that same 10x potential. And first up here, just under $5 a share and $784 million market cap, Altus Power, ticker AMPS, providing over a gigawatt of solar power services across 25 states in a market that's seeing a boost from the AI data center boom. Altus expects to grow megawatt capacity by 20 to 30% a year over the next 3 years and still has a lot of room to grow into its market. At a 4% share, the company leads in its commercial scale solar with a market potential that is 20 times larger. I'll show you what I'm looking for in these penny stocks later, but Altus has the growth that we need, increasing revenue at a 37% annual pace. And while cash flow is a little shaky, it has enough liquidity to keep going and grow into that potential. Next, at $2.60 a share, $140 million PaySign Inc., ticker PAYS, a prepaid card and payment processing service for customer incentives, employee rewards, and rebates within the healthcare, hospitality, and retail industries. The company provides an end-to-end and customized solution for enterprise clients, an addressable market it estimates as large as $728 billion in the U.S. alone. Revenue growth has accelerated over the past year to a 30% annual pace, and with pharmacy patient affordability programs taking off. But even on that, current sales of $56 million are just a fraction of that potential market. Sales growth is expected to slow a little to 13% this year, but the company is already profitable, so that's going to de-risk this stock a little bit more than we usually see in these penny stocks. We've still got 3 more of those penny stocks to highlight, but I want to get you started with what I'm watching for in here and how to dig into the research yourself. Now, once you've found a penny stock that you want to research further, and again, the stock price isn't really the deciding factor here, folks. We're really looking for stocks of companies under $1 billion market cap, so those super small companies with the potential to grow 10x into their market size. Then you're here in the income statement, and you're looking for revenue growth of 20% a year and higher. You can go as deep down into the rabbit hole of financial statement analysis as you want, but with penny stocks, it's got to start here with growth, because the market can overlook a lot of things in a growth stock. Poor profitability, even losses, low cash flow and debt, but as long as the company is growing that revenue, you could have a penny stock candidate. Here we see an Altus Power that on almost $185 million in last year's revenue, the company has grown sales by 159% over the last 3 years for a 37% annual pace. And from there, you want to look at the statement of cash flows. Growth might be king for penny stocks, but cash is like oxygen, and the company won't be able to survive for long without it. In the best penny stocks, you want to see that positive cash generated from operations and free cash flow. At a minimum, though, you'd like to see an increasing trend to higher operating cash flow. AMPS had that until the trailing 12 months, so we'd want to see why that operating cash flow took a hit. If operating or free cash flow is negative, you do also want to see there's enough ending cash position to cover those cash needs and give the company time. And now before we get back to that list of penny stocks, most of these very small companies aren't closely followed by analysts, but when they do have that coverage, it helps also to check those expectations. Sales growth for AMPS is expected to slow down about 13 to 16% in fiscal 2025, with earnings falling to just a penny per share. So while that growth has been very strong in the past and the stock deserves a look, we want to research further to see why sales and earnings are seen struggling. There is a lot more research you can do, but this is a minimum here, analyzing that trend in revenue and preferably profitability on the income statement, then looking at the company's cash-generating power before digging further into what's coming over the next few years. Back to our penny stocks under $5, and Talkspace, ticker TALK, at a $689 million market cap, may be moving the mental health space into the future. The company provides a virtual mental health platform connecting therapists and professionals to their patients anytime and from anywhere, with over 6,000 providers managing 316,000 sessions in the most recent quarter. Even a fraction of the $65 billion market for mental health services would mean supernormal growth from the company's $181 million in current revenue, which grew at 25% annual pace in the last year. And now Talkspace is using AI not to replace the clinical professional, but to augment their work and help them cover more patients. We've highlighted Lantronix, ticker LTRX, before on the channel, with the shares doing well until just recently, but with the potential to break higher again. The company provides solutions in video surveillance, infotainment, and intelligent substations operating in 3 core areas: software as a service, value-added hardware, and industrial users. Even on slightly lower revenue in the trailing 12 months to $155 million, the company still grew by a 29% annual pace and is still cash flow positive with plenty of cash on hand. This is a good play in the AI use case for some growing themes like surveillance and infotainment that can be expanded into other verticals, so well worth the risk here. The smallest penny stock on the list at just $104 million, and probably the riskiest, is Tela Bio, ticker TELA, a medical device maker designing and marketing tissue reinforcement materials for soft tissue reconstruction. Tela focuses on the $1.5 billion market for hernia repair, which is more than 1 million procedures annually and a $700 million opportunity in reconstructive surgeries. But this technology could find broader use cases as well. While revenue growth has been strong, up 133% in the last 3 years for a 32% annual pace, the cash flow statement is pretty awful here and doesn't seem to be getting it much better, so this one has the potential but needs more research. Now for the stocks I'm watching this week, Intel Corporation, ticker INTC, is seeing some huge interest, and it could be secret buying before a takeover offer. The shares saw over 792 million shares traded in just 4 days last week, an average of almost 200 million shares a day, against an average volume closer to just 60 million shares a day over the month before. The stock spiked 23% last week on this buying interest, and news to spur the move was relatively light. There were rumors that the company may be in talks for a collaboration with Taiwan Semiconductor for its foundry business, but I'm not sure that would be enough to justify this kind of a price move. There have also been rumors of private equity or other buyers circling the company, and we could hear news on that soon. Walgreens Boots Alliance, ticker WBA, got good news last week, even if the market didn't realize it. CVS Health, ticker CVS, reported full-year revenue of $373 billion, beating expectations and marked 4% sales growth from the year before, sending the shares up 15% on the day and 22% for the week. CVS still saw some weakness in its healthcare benefit segment, but pharmaceuticals and healthcare services were both up. That's good news for WBA because it's more heavily exposed to the pharma and services side, that the market didn't make the connection here, with the shares down 4% on the week. Now, shares of CVS trade cheaply at an enterprise value of 0.42 times its sales. Now, that enterprise to revenue valuation, that's the measure you want to use for these highly indebted companies. But Walgreens is even cheaper at just 0.25 times sales, a 40% discount. And it strikes me as kind of a disconnect and an opportunity here in the market. We already know that private equity buyers have been talking to Walgreens and that it has been closing unprofitable stores, selling off non-core assets, and suspending its dividends, all to pay down that debt. All of these are classic moves to improve cash flow and debt before a private equity sale, and yet the market is ignoring the fact that these shares could get at least $12.50 and likely higher in a sale. The industry is still struggling, and Walgreens has a dangerous amount of debt, but there is a near-term opportunity here for the shares to pop higher. NVIDIA, ticker NVDA, released its updated 13F filing with the SEC Friday, detailing the stocks the company is holding, and there were some big changes here. NVIDIA dumped its shares in Server Robotics and SoundHound AI, both long-term investments, and sent both stocks down more than 30% on the news. NVIDIA also cut its exposure to other stocks, but the big news was a new investment in Chinese autonomous vehicle firm WeRide, ticker WRD, which sent the stock surging 80% on the news. I'm still holding shares of SoundHound AI up 160% even after that crash, but I'm going to prepare a full video detailing the changes and how to invest. I'm also watching Arista Networks, ticker ANET. It's going to be reporting its earnings on Tuesday with expectations for a strong close to 2024, with revenue up 19% to $6.97 billion. Now, if you watched Friday's video of the best AI stocks to buy into the data center buildout, you know this is one of my favorites, and revenue is expected to continue at that 19% pace to $8.3 billion this year. Their shares are not particularly cheap here at 21 times price to sales, but Arista has a strong focus on AI networking equipment, what is likely to be the next big bottleneck for data centers, and the company's sales outlook should be very positive. Rivian Automotive, ticker RIVN, also going to be reporting its earnings this week on Thursday with a stock up 40% since mid-November, but still down 10% over the year, with investors still worried about that EV truck maker. Now, if we don't get good news this week, I expect it's coming soon, as two key headlines have broken over the last month. First, Rivian recently announced it's opening up its commercial van sales to fleet buyers. Until late 2023, the company was locked into an exclusive agreement with Amazon, and while it still supplies Amazon with those trucks, it now has the capacity to explore other buyers as well. It's a new development, but could boost sales forecasts for this year and next. Potentially bigger, though, is news last month that other automakers are interested in licensing the software and electrical architecture Rivian is developing in its $5.8 billion partnership with VW. Cash flows are still ugly here, but the company has that financial survivability it needs with that VW partnership, and shares had their best day ever in January when the company reported its 2024 production numbers. The stock trades for just 2.9 times sales, which is expected 10% higher this year, and I continue to believe if the company can ramp up its production to the point of efficiency, this will be the stock you wished you owned 5 years from now. Showing you that bigger picture here with the Sector Spiders sector tracker. 9 of the 11 stock sectors closed higher last week, with typical growth areas like technology and communication services doing really well. Healthcare saw broad weakness, with only 18 of the 61 stocks in the sector rising for the week, as drug makers and device makers saw shares there fall on earnings. Now, I continue to be a big buyer of healthcare stocks, especially pharmaceuticals, on those expectations for strong earnings growth over the next quarter. Stocks in the energy sector are by far the biggest laggard over the past 3 months, down 5% versus a market up almost 3%, and is the only sector down over the last month. With the price of crude finding support around $70 a barrel, and intelligence reports last week that Israel is planning strikes against Iran's nuclear facilities, leading to potential headlines out of the Middle East that could send oil spiking. The risk return is back on energy's favor. Oil explorers are still strongly cash flow positive at $70 a barrel, so dividends are healthy, and the upside in energy prices is going to see those stocks rebound quickly. Now, both the Consumer Price Index, the CPI, and the Producer Price Index, that PPI, measures of inflation, came in much higher than expected last week. The market largely shrugged them off because we've already lowered our expectations to just one more Fed rate cut this year, but an escalating tariff war could send inflation even higher. We also saw last week that retail sales in January suffered their biggest drop in a year. The sales were expected to fall just 0.2% from the month before, but instead plunged 0.9% on the month, the worst since January of last year. Now, some of this could have been from a hangover on a strong holiday shopping season and a colder than normal January, but there's also little doubt that consumers are stretched and slowing their spending. Combine this with the January's job report, which showed just 143,000 jobs created last month, and it's a clearly weakening picture for the jobs market over the last 2 years. You get the impression this isn't the kind of healthy economy that makes stocks boom. Nation, stocks are undeniably expensive, and we could get a catalyst for a sell-off and a surprise bump to inflation over the next few months. The problem in this circle the wagons negativity is that investor sentiment is still strong, and household finance is still healthy. Stocks can keep rising, and markets can stay in that bubble for a lot longer than the data reflects, so investors shouldn't rush to sell or protect their positions too aggressively. Now, that's why I highlighted the barbell approach I'm returning to last week, holding just over half of my portfolio in those growth and tech stocks, but then the remaining in very safe money market and bond funds. Now, this keeps my exposure to the rising stock market and the stocks that are going to produce those best returns if that bull market keeps charging, but it's going to reduce my downside risk and provide ready cash to invest at the lower prices if stocks do crash. Get your $150 discount to the options investing course with the coupon code in the link below. Get walkthroughs on all 29 option strategies. Get the options strategy fighter to make sure you're using the best strategy, and that options calculator to know exactly how much you can make. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.